Gold just crossed $5,000. And if you're watching this thinking, okay, cool, another milestone, another headline, another reason for people to get excited on the internet, I get it. I really do. But here's the thing. I'm sitting here on a Monday morning, coffee's getting cold because I keep forgetting to drink it, and I'm looking at these charts thinking, wait a minute, this isn't just about a round number. This is about what's happening underneath the number. And I wasn't planning to make this video today. I had other things on the list. But then I saw the overnight moves. I saw the dollar breaking down. I saw silver ripping higher again. And I thought, okay, fine. You deserve to know what's actually going on. Not the headline version, the real version. So here it is. It's Monday, and I'm recording this from my desk surrounded by way too many screens and not enough sleep. Comment below what day and time you're watching this and tell me where you're watching from. I'm genuinely curious. Are you in Asia, Europe, the Americas? Let me know because this market is moving around the clock and I want to know where my people are tuning in from. Quick thing before we dive in. If you find this breakdown useful, if you appreciate someone actually walking through the details instead of just screaming buy or sell at you, then subscribe and drop MRAG in the comments so the algorithm knows you're here for real analysis. It helps more than you think, and it helps me keep making these videos instead of whatever else the platform wants to push. Okay, let's talk about what just happened and why it matters. Gold is trading above $5,000 per ounce. As of the latest data I'm looking at, spot gold is sitting around 5,017, 5,020, somewhere in that range depending on when you check. That's after a nearly 4% climb on Friday, 4% in a single session for gold. That's not normal, that's not sleepy institutional rebalancing, that's something else. And silver. Silver is up over 5% today alone. It's trading around $81, $82 per ounce right now. And here's the part that most people either forgot or never knew in the first place. Silver hit an all-time high of $121.64 on January 29th. That was just weeks ago. And then it pulled back hard. And now it's bouncing. And the question everyone should be asking is simple. Is this the start of the next leg up? Or is this just a dead cat bounce before we go lower? I'm going to walk you through what's actually driving this move, why the dollar matters more than most people realize, what China is doing that almost nobody is talking about, and the three realistic scenarios from here. The boring one, the explosive one, and the one that could change how we think about these markets for years. Let's start with the obvious driver, the dollar. The US dollar index just dropped to its lowest level since February 4th. And if you don't follow currency markets closely, you might think, okay, so what? But here's why it matters for anyone holding gold or silver or anything priced in dollars. When the dollar weakens, it takes fewer units of other currencies to buy the same amount of gold or silver. So for international buyers, for the guy in Tokyo or the institution in London or the central bank in Beijing, American metals just went on sale. Not because the metal changed, because the measuring stick changed. Think of it like this. Imagine you're at a store and everything is priced in a currency you don't use. If that currency suddenly drops 10% against your currency, every item in the store just got 10% cheaper for you. You didn't do anything. The store didn't do anything. The exchange rate did the work. And that's exactly what's happening right now. The dollar is sliding, and gold and silver are catching a bid from overseas buyers who suddenly see value they didn't see last week. But here's where it gets more interesting. The dollar isn't just falling because of random market noise. The dollar is falling because of what's happening at the Federal Reserve. And I need to be careful here because I'm not trying to turn this into a political thing. I'm trying to explain market mechanics. So let's stick to what's been reported. According to recent reports, U.S. Treasury Secretary Scott Bessent made comments suggesting there could be an investigation of Fed Chair nominee Kevin Warsh if interest rates are not lowered. Now, I'm not going to speculate on whether that's appropriate or not. That's not my job. My job is to tell you how markets are reacting. And markets are reacting by selling dollars. Why? Because anything that threatens the perceived independence of the Federal Reserve makes investors nervous. The whole point of having an independent central bank is that monetary policy is supposed to be based on economic data, not political pressure. When that independence looks shaky, even a little bit, money starts looking for safety. And where does money go when it wants safety? Gold. Always gold. So you have a weakening dollar and you have concerns about Fed independence. That's two tailwinds at once. And we haven't even talked about China yet. The People's Bank of China has been buying gold for 15 consecutive months, 15 months in a row. Their holdings just increased again to 74.19 million ounces. And this isn't speculation. This isn't rumor. This is official data from the central bank of the world's second largest economy. Now, why does this matter? Because China is the largest buyer of gold on the planet. When they're accumulating, it puts a floor under prices. When they're accumulating for 15 straight months, it tells you something about their long-term view. And here's the thing most Western analysts miss. China doesn't buy gold because they're trying to trade it. They're not looking at RSI and MACD and trying to time entries. They're building reserves. They're diversifying away from dollar assets. They're preparing for a world where the dollar might not be the only game in town. So when you see headlines about gold crossing 5,000, you need to understand that there's a structural buyer underneath this market who doesn't care about your Fibonacci retracements. They care about geopolitical positioning. They care about decades, not days. And speaking of geopolitics, let's talk about what's happening with Iran. According to recent reports, there were high-level talks between U.S. and Iranian officials. Iran's president called the meetings a step forward. Their foreign minister emphasized the need for calm dialogue without pressure. And the former U.S. president apparently said another meeting will happen early this week and warned of serious consequences if no deal is reached. Now, I'm not a foreign policy expert, and I'm not going to pretend to know how these talks will end. But I can tell you this. When tensions in the Middle East rise, gold rises. When tensions ease, gold can pull back. But here's the nuance. Even the uncertainty around whether tensions will rise or fall is enough to keep a bid under safe haven assets. Traders hate uncertainty more than they hate bad news. With bad news, you can position. With uncertainty, you're just waiting. And while you're waiting, you hedge. And how do you hedge geopolitical risk? Gold. So, let's stack this up. We have a falling dollar, we have concerns about Fed independence, we have China buying for 15 straight months, we have Middle East tensions creating headline risk, and we have major U.S. economic data coming this week, including the jobs report, which got delayed and is now expected Wednesday. That's a lot of cross currents. And if you're trying to understand why gold is above 5,000 and silver is ripping higher, that's your answer. It's not one thing. It's everything hitting at once. Now let me talk about silver specifically because silver is doing something interesting and most people are focused on gold. Silver hit $121 on January 29th. That was the high. Then it crashed. And I mean crashed. We saw it fall all the way down to the mid-60s at one point. That's a 40% plus drawdown from the highs in weeks, not months, weeks. And now it's bounced. It's back above $80. Today it's trading around 81, 82, up over 5% in a single session. And the question is whether this bounce has legs or whether it's just a relief rally before more pain. Here's what the technical picture looks like based on the analysis I've been reviewing. Silver is still below its 50-day exponential moving average around 84.50. It's definitely below its 200-day around 92. So from a pure trend perspective, the bigger picture is still corrective. The trend is down until proven otherwise. But here's the counter-argument. Silver just bounced hard off a major demand zone between $68 and $70. That zone held. Buyers showed up. And now we're seeing follow-through. The question is whether silver can clear 84.50, then 92.24. Those are the levels to watch. If it clears them, the narrative shifts. If it gets rejected, we could retest the lows. And here's something one analyst pointed out that I think is worth repeating. Unless silver clears above that 92.24 level, the probability of a medium-term uptrend remains low. That's not me being bearish. That's just respecting the chart. But I'll tell you what I'm watching. I'm watching whether silver can hold above 80 on pullbacks. If every dip gets bought and we start making higher lows, that's a sign the character is changing. If we fail here and drop back below 75, the bear case gets stronger. So what does this mean for you practically? Let me give you 3 scenarios and then a framework for thinking about this. Scenario 1, the boring scenario. The dollar stabilizes, the Fed concerns fade, the jobs data comes in okay, geopolitical headlines calm down, and gold and silver just chop around these levels for weeks. Gold oscillates between 4,900 and 5,200. Silver bounces between 75 and 85. Everyone gets bored. Everyone moves on to arguing about something else on the internet. This is actually the most likely scenario in terms of raw probability. Markets spend most of their time consolidating, not trending. The exciting moves get all the attention, but the boring moves are the majority of price action. In this world, you don't need to do much. You hold what you have, you don't panic buy, you don't panic sell, you wait for clearer signals. Scenario 2, the explosive scenario. The dollar continues breaking down. Fed independence concerns escalate. China keeps buying. Geopolitical tensions spike. The jobs data disappoints. And suddenly everyone wants gold and silver at the same time. In this world, gold doesn't just hold 5,000, it pushes toward 5,500 or higher. Silver doesn't just hold 80, it challenges that 92 resistance and potentially runs back toward the highs. This is the scenario that gold bugs dream about. And I'll be honest, the setup is more favorable for this scenario than it's been in a long time. Multiple tailwinds aligning, structural buying from central banks, dollar weakness with no clear catalyst for reversal. But I'm going to be the adult in the room for a second. Just because the setup is favorable doesn't mean it happens. Markets can stay irrational, correlations can break, and the fastest way to get hurt is to assume a scenario is guaranteed. Scenario 3, the credibility shift. This is the one nobody wants to talk about, but I think it's worth considering. What if the relationship between paper prices and physical availability starts to fray? What if the gold you can buy in Shanghai starts trading at a different premium than the gold in New York? What if the futures price becomes more of a reference number than an actual price you can transact at? We've seen hints of this before. There have been periods where Asian pricing has stayed firm versus Western futures, then snapped back, then widened again. Some analysts have pointed out stretches where premiums looked unusually large between different regions. This isn't conspiracy theory. This is what happens when logistics, financing, and trust start mattering more than the screen price. And in a world where central banks are accumulating physical metal while paper markets trade trillions in derivatives, the gap between those two worlds can widen. I'm not predicting this happens tomorrow. I'm saying it's a scenario worth having in your mental model. Because if it does happen, the people who only think about price will miss the bigger shift in how these markets function. Now let me give you a practical framework because I don't want you leaving this video with just information. I want you leaving with a way to think about this. Step 1, know why you're in this market. Are you trading, investing, hedging something else, speculating on a specific move? The right answer depends entirely on your goal. And if you don't have a clear goal, the market will give you one. Usually at the worst possible moment. Write it down, seriously. Write down why you own gold or silver or whatever you own. Because when prices move against you, that piece of paper will remind you whether to hold or fold. Step 2, size your position so you can survive stupidity. I've seen people blow themselves up not because they were wrong about direction, but because they were right about direction and sized wrong. They used too much leverage. They put too much of their net worth in one idea. And when the market moved against them temporarily, they got liquidated right before the move they expected. If gold drops to 4,500 tomorrow, can you survive that? If silver drops back to 65, are you okay? If the answer is no, you're too big. Reduce. I don't care how bullish you are. Survival matters more than conviction. Step 3. Understand what you actually own. Do you own physical metal in your possession? Do you own allocated metal in a vault somewhere? Do you own shares in an ETF? Do you own futures? Do you own options on futures? Do you own mining stocks? These are all different things with different risk profiles. Physical metal has no counterparty risk but has storage and liquidity friction. Paper products are convenient but depend on someone else's promise. Mining stocks give you leverage to metal prices but also give you company-specific risk, jurisdiction risk, management risk. There's no right answer. There's just the answer that matches your goals and your risk tolerance. But if you can't articulate what you own and why you own it in that specific form, you're gambling, not investing. Step 4, define what would change your mind. If you're bullish, what would make you bearish? If you're bearish, what would make you bullish? If nothing would change your mind, you don't have a thesis. You have a religion. For me, watching silver, I'm watching 84.50 and 92.24 on the upside. If those levels break, the picture changes. On the downside, I'm watching 73 and then 65. If those levels break, the picture gets darker. For gold, I'm watching whether 5,000 holds as support. If it does, and we build a base here, bullish. If we fail back below 4,900 and then 4,800, something shifted. I'm also watching the dollar. If the dollar reverses hard and starts ripping higher, that's a headwind for metals regardless of what the fundamentals say. Price pays. Now let me address something that's probably on your mind. You might be thinking, okay, but these prices seem insane. Gold at 5,000? Silver above 80? Is this sustainable? And here's my honest answer. I don't know. Nobody does. Anyone who tells you they know for certain is either lying or trying to sell you something. What I can tell you is that prices are not arbitrary. They reflect supply and demand, yes, but they also reflect beliefs about the future. And right now, the belief set includes dollar weakness, inflation concerns, central bank accumulation, geopolitical uncertainty, and questions about the stability of the financial system. If those beliefs persist, these prices can persist. If those beliefs change, prices can change. It's that simple and that complicated. But here's what I'll also say. Historically, precious metals have not gone to zero. Fiat currencies have. That's not an argument for buying at any price, but it is an argument for having some allocation if you believe that currency debasement is a real risk over time. The question isn't whether to own gold or silver. The question is how much, in what form, and at what price. Now, I want to zoom out for a second because I think we're missing something important in all the price talk. We're living through a moment where the global monetary system is being questioned in ways it hasn't been questioned in decades. The dollar's role as the sole reserve currency is being challenged, not by one country, by coordination among multiple countries. China's buying gold, Russia's buying gold. Central banks around the world increased their gold holdings last year at the fastest pace in decades. This is not random, this is policy. And at the same time, Western central banks are trapped. They can't raise rates too much without blowing up their own government's interest expense. They can't lower rates too much without reigniting inflation. They're stuck. Gold doesn't have these problems. Gold is nobody's liability. It's not a promise. It's not dependent on someone else's balance sheet. And in a world where balance sheets are stretched everywhere you look, that matters. So when you see gold at 5,000, yes, it's a high price historically. But historically, the monetary system wasn't under this much stress either. Context matters. All right. Let me land this plane because I've been going for a while and I know your time is valuable. Here's what I want you to take away from this. Gold above 5,000 is significant, but it's not the whole story. The dollar breakdown, the Fed concerns, the China accumulation, the geopolitical tensions, these are the drivers. The price is just the scoreboard. Silver is more volatile and more tricky to navigate. It hit 121 and crashed back to the 60s. Now it's bouncing. Watch the key levels. 84.50 on the upside. 73 on the downside. Don't fall in love with the direction. Respect the price action. The next few days could be pivotal because of the jobs data. If the data is weak, it supports rate cut expectations, and that's bullish for metals. If the data is strong, it complicates the picture. Don't assume you know the outcome. Be prepared for both. And finally, take care of yourself. I know that sounds weird in a market video, but I mean it. This stuff can be consuming. Prices moving, charts updating, headlines screaming. It's easy to let it take over your mental bandwidth, but your life is more than your portfolio. Your relationships matter more than your returns. Your health matters more than your holdings. So yes, pay attention. Yes, be informed, but also turn off the screen sometimes. Go outside. Remember that this is a tool for building the life you want, not the life itself. Okay, I've said my piece. If this breakdown helped you see through the noise, if it gave you something to think about that you weren't going to get from the usual headlines, then do me a favor. Subscribe, drop MRAG in the comments, and share this with one person who you think needs to hear it. Also tell me this, do you think we're closer to the boring scenario, the explosive scenario, or the credibility shift? I want to know how you're reading this. Drop your take in the comments. And tell me where you're watching from, what time zone, what country, what city. I read these comments, and I'm always amazed at how global this community is. All right, I'm going to go reheat this coffee for the third time and stare at some more charts. If something major happens this week, I'll be back with an update. Until then, stay sharp. One more thing. This is educational content based on publicly available market information and my interpretation of various reports and analyses. It is not personal financial advice. I don't know your situation, your risk tolerance, or your goals. Do your own research. Talk to a qualified professional if you need personalized guidance. And never invest money you can't afford to lose. See you in the next one.